Support for the show comes from Public. Public is an investing platform that offers access to stocks, options, bonds, and crypto. And they've also integrated AI with tools that can assist investors in building customized portfolios. One of these tools is called Generated Assets. It allows you to turn your ideas into investable indexes. So let's say you're interested in something specific like biotech companies with high R&D spend, small cap stocks with improving operating margins, or the S&P 500 minus high debt companies. Chances are there isn't an ETF that fits your exact criteria. But on Public, you just type in a prompt and their AI screens thousands of stocks and builds a one-of-a-kind index. You can even backtest it against the S&P 500. Then you can invest in a few clicks. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Ad paid for by Public Holdings. Brokerage services by Public Investing. Member FINRA SIPC. Advisory services by Public Advisors. SEC registered advisor. Crypto services by Zero Hash. Sample prompts are for illustrative purposes only, not investment advice. All investing involves risk of loss. See complete disclosures at public.com/disclosures.
Small businesses are the pulse of every community. They bring people together, create opportunities, and drive growth. Chase for Business helps business owners like you with personalized guidance and convenient digital tools all in one place. With that guidance and your determination, you can take your business farther and help build a brighter future for your community. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. JP Morgan Chase Bank, N.A. Member FDIC. Copyright 2026, J.P. Morgan Chase & Company.
You need to make a huge presentation in an hour. Luckily, Adobe Acrobat Studio uses AI to take all your documents and generate a presentation with a single click, building slides faster than ever before. So if you need a last-minute pitch deck, do that with Acrobat. Need to level up your presentation design? Do that with Acrobat. You have 30-plus documents that need to be simplified into a proposal? Do that with Acrobat. Learn more at adobe.com/do-that-with-Acrobat.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Today, my co-host is James Seyffart, senior ETF analyst at Bloomberg Intelligence. James, thank you for joining me today.
Yeah, happy to be back, David, and with one of my favorite guests and clients to talk to.
So we all know passive investing has become the default choice for a lot of investors, but the conversation usually stops at fees and simplicity. A lot less time really is spent talking about what happens when passive becomes a dominant force in the markets and what that means for active managers trying to generate alpha. So our guest today has been digging into that question for years, and I'd like to welcome him. Michael Green, chief strategist and a portfolio manager at Simplify Asset Management. Thanks for joining us, Michael. So, James, why don't you start us off?
Yeah, I mean, where we have to start off anytime I have this conversation with Michael, and it usually ends up in a little bit of a debate because we don't fully agree, but we agree on some of the key points. But I guess really what I think we should define for the audience is like what your definition of passive is, because I view it as, a complete spectrum. There's from passive to active. There are some people who are more absolutist in how they view it. Everyone, it's kind of one of those things where like, if you don't define it beforehand, people end up talking past each other. So Mike, why don't you just walk through like what your definition of passive is when you tend to be talking about these things?
Well, when I focus on passive, first of all, I just want to be clear. There is no such thing as a passive strategy. That's one of the key points that I raised in my analysis of the concept of passive investing as a thought experiment from the 1960s that was projected forward and added, given additional depth by Bill Sharp in 1991 with a paper called The Arithmetic of Active Management, which is the source of all the analysis that you hear that, active managers and passive managers own the same underlying securities, and therefore the only difference between them is the fee structure. That's what drives the outperformance of the passive strategies, quote unquote. Unfortunately, Sharp's definition, as was highlighted by a partner at AQR, Lasse Peterson, in 2016, relies on magic. because his definition of passive is somebody who never buys or sells, they simply hold. That means it's impossible for them to get into the market. It means it's impossible for them to get out of the market. Once you realize, and he defines an active investor as anyone who is not passive. So by definition, all investment is active. What we are really referring to when we talk about passive is the attempt to replicate market cap weighted indices that largely dominates the passive world. There's lots of discussions around active ETFs, et cetera. Most of those are some variant of 2 times levered NVIDIA or call overwriting strategies, et cetera. They aren't really active in the traditional sense. True active investing relies on the discretion of the allocator, the portfolio manager, to select securities on the basis of, candidly, whatever they want, right? They could choose all stocks starting with the letter A, and they could also decide that they wanted to focus their research on predicting the forward cash flows of a company. Both would be considered active. When we're talking about passive and when we talk about the scale and size and the impact, what I am largely referring to is market cap weighted indices, in particular the S&P 500, to a lesser extent the NASDAQ 100, and extensions thereof like the total market indices and the Russell 2000.
So if we talk about that, I mean, you've been one of the most vocal critics of these type of products. What do most investors misunderstand about how passive flows actually affect market prices?
Well, I think it all starts with that label, right? They are not passive investors. So I think we actually have to start with that observation. The moment we recognize that they aren't passive and instead they regularly buy and sell securities, we know what they actually are, which is, they are systematic algorithms that when given cash will buy things in proportion to their market capitalization. When asked for cash, they will sell things in proportion to their market capitalization. That has very predictable effects on price behavior, on what's referred to as market elasticity, how prices react to changes in supply and demand. And at this point, the academic work and the theoretical work has moved so far beyond where the practitioner space is that we increasingly are aware that this is turning into the driver in markets today.
So when did these products stop being a price taker and become more of a price maker, or are we already there?
Oh, we've been there for a very long time. So this is actually what I refer to as passive 2.0. Passive 1.0 actually began in the early 1990s as Vanguard and other participants in the passive space grew to 1% to 2% market share. They began to experience the bane of passive investing's existence, tracking error versus their indices. This is because they'd grown to a size that when they went to transact in all the individual securities in the S&P 500 or in smaller indices, they were having a noticeable impact on those securities, creating conditions under which they would experience tracking error. They were diverging from the indices. They went to Wall Street for helpful advice. How can we solve this? The street kind of looked at them weird and said, why are you buying every security? Why don't you just buy futures? And the answer to that was, well, we can't, because the 40 Act restricts the ability of mutual funds to access leverage. Margin accounts are required to trade futures, and so we are restricted from using futures for this entry process. The street's recommendation was to lobby the SEC. Vanguard did so, received what's called a no-action letter in 1994 that allowed them, somewhat uniquely, along with other index investors, to ignore the rules of the 40 Act and to begin to transact in futures. That ran it headlong into a market structure issue, which is at the time the indices were market cap weighted. Most people think they still are. They're not. They're float adjusted today. That change happened in 2003. But in the early 1990s, what it meant was that passive investors were trying to buy more shares than were actually freely available in low float stocks, companies like Microsoft, Cisco, Dell, etc., stocks with high levels of insider ownership. And we began to see the effects of this almost immediately in market structure and market behavior. Passive 1.0 was really what facilitated the dot-com bubble. In 2003, we changed the structure of the indices to float adjusted. That bought us additional capacity. And my work suggests that somewhere around 2015, 2016, we exceeded the thresholds that increased capacity allowed us and began to meaningfully impact markets again. Today, I think it is the single most dominant force in markets.
So you talked about some of the inelasticity of this buying and selling. Um, Whether or not somebody is fully on board with the way you think about passive investing, this is something that is, more objective fact than anything else. Can you just talk about the idea of basically $100 or $1,000 being invested into an index or a stock having much more of an impact on the underlying valuation than, the $100 or $1,000 that's going in? Can you explain how that works and why it happens and what the consequences are?
Sure. So the premise of elasticity within markets is something that is assumed within the efficient market hypothesis, which is really the primary underpinnings of the passive investment revolution. The idea that market prices represent all the best information that is available at any one point in time. And people are able to invest almost unlimited sums without disrupting that market. The actual specification for the efficient market hypothesis is that a dollar into the stock market, because there has to be a seller on the other side, really only changes market value by roughly the bid-ask spread. So a dollar in creates about a penny of additional market cap is the EMH framework. In 2020, two academics, Xavier Gabay at Harvard and Ralph Koijan at Chicago, did a very disciplined analysis of this and found that the average over the time period from 1992 to 2019 was actually between about $5 and $8 of market capitalization being created for each dollar that was going in. Their paper was called the inelastic market hypothesis and was really one of the primary academic revolutions that is underway in finance right now, understanding this concept of elasticity and how it is changing in markets. But really importantly is that observation that it was an average from 1992 to 2019 that was cited in that paper. Subsequent work by Valentin Haddad at UCLA has identified that this is actually a trending series that is a function of passive share. And my work at this point, which Valentin would largely echo, is that we are looking at somewhere for the mega cap stocks like Apple, Nvidia, Microsoft, about $70 of market capitalization being created for every dollar that is going into the market. This is why you can see a $340 billion market cap swing on a company like Microsoft, nowhere close to 340 billion, or more accurately on the EMH. 340 billion would be 34 trillion in order to get that impact. It really was more on several hundred million to possibly $1 billion in relatively thin markets that are closed that cause that type of impact. So we're discovering that markets are radically less elastic than we had assumed.
So I guess, is it just valuations that are being distorted? Are you looking at more volatility, lower volatility? Like, what is actually being distorted here from your point of view in the overall markets?
Well, the primary component that's being distorted is what's called price discovery, right? So we actually effectively have a market that no longer has a form of memory. We as individual humans experienced the variant of this in the COVID pandemic. We'd go to the grocery store. We thought that eggs are supposed to be $3 a dozen. They're $5 a dozen. That creates chaos, right? What's going on? This doesn't make any sense. As we continued through that pandemic, people increasingly became unhinged from the historical price level, and they basically accepted whatever price was available for eggs. That's the same phenomenon that happens with passive. You effectively lose the memory of what is a meaningful price level, and you effectively adopt whatever the last price is. Passive is like an investor who has zero memory.
So if we take a step back and think about the market as a whole, and just thinking about systemic risk, where is that risk hiding in this kind of index product dominant heavy market?
Well, it is unfortunately a true systemic risk, right? What we have actually done is we introduce an agent who we effectively, in a paperclip world variant, right? When you think about automation, we just said, well, go buy. At what price? Whatever price you can get. Right now, what that has actually done is inflated valuations. If you think about the impact of a growing pool of agents whose response to at what price is whatever price, I don't care. The people selling to them will be able to extract higher and higher prices over time. Those prices will become increasingly disjointed from the fundamentals, we'll construct a narrative around it, right? They're better companies, they have better growth opportunities, productivity is going to surge right around the corner, et cetera, because that's what we do as human beings, right? Remember, we as a species for thousands of years believed that the sun transited the sky being dragged behind a golden god. We will literally believe anything, including stuff that Elon Musk says. The simple reality is that when you create those conditions, you set the stage for what was very well articulated in a 2004 academic paper by Michael Jensen called The Agency Costs of Overvalued Equities. And he highlights that effectively, if an equity becomes overvalued, there really is no mechanism to discipline the management team. And they have every incentive in the world to justify the existing valuation in their behaviors. If they believe that they are being rewarded for incredible growth opportunities, they will invest like they believe there are incredible growth opportunities. And unfortunately, I think that's what we're largely seeing. On the flip side of it, many industries that suffer from neglect under this framework are told that capital is not available to them, and as a result, they underinvest. And that broadly is a pattern that's playing across our economy, where privileged companies that happen to be large enough to be in the public equity indices are receiving differential cost of capital and a much lower cost of capital that allows them to invest. While businesses that are not privileged in that way, your local mom and pop grocery store or hardware store, are suffering from neglect and an inability to obtain investable funds.
So do you think that regulators actually understand, this feedback loop that it's creating?
I think it depends on which regulators you refer to. I like to point people to a conversation I had in 2018, soon after the events of Volmageddon, which I think you both know I was involved with. In which I met with the Bank of International Settlements and their financial crisis group, and their reaction to my work was, yeah, we think you're right. And they've subsequently written a few papers on it that tread very lightly on this topic. My reaction to that was, oh, that's fantastic. How can I help? What can we do to ameliorate this condition? I did not go public. My goal was not to incite panic in the crowds. My goal was to get regulators to change it. And their response, unfortunately, was, there's nothing we can do. Because what you don't understand is the regulatory apparatus is controlled by BlackRock and Vanguard. And if we raised the alarm and the event didn't happen immediately, we would simply be fired.
And so one of the things, I track active management. I've been looked over time as, the amount of alpha that's being produced by, say mutual fund managers and now ETF managers has kind of fallen quite a bit. And so do you think that the growth of these index tracking products is making active management harder, or does it actually increase the opportunity for some active managers?
Well, the answer is both, but it's just a function of timescales, right? So this is a variant of what John Maynard Keynes observed. The markets can remain irrational far longer than you can remain solvent. As long as people are piling money into passive strategies and passive continues to gain share, there's really not much prospect for active managers on a continuous basis to underperform. That's actually a direct byproduct of how we calculate things. So if you think about a market that has a function that causes valuations to increase over time, in other words, the returns at any unit of risk are actually rising, that creates a positively convex surface. The measures that we use, as you talk about alpha, for calculating active manager performance is actually a linear equation, y equals mx plus b. The return on my portfolio is the beta times the market plus some idiosyncratic factor we call alpha. That alpha is simply the intercept. And if you just draw a curved surface and you run linear equations on it over time, you will actually find that those intercepts are forced negative. That perfectly matches the experience of the active manager community. So very quickly, this is actually proprietary research that I did back in 2017. I asked the question of portfolio managers, you're a portfolio manager, you are given new capital or capital is taken away from you. What's the likelihood that you'll deploy funds or sell securities to meet a redemption given some type of valuation? Valuation is on the x-axis. Your marginal propensity to either buy or sell is on the y-axis. These are the cumulative results across roughly 450 responses, and unsurprisingly, you find a marginal propensity to sell as valuation rises and a marginal propensity to buy as valuations fall. That's not surprising. Those are standard downward sloping demand curves in economics. It's this intersection between the two that's actually really interesting. The two cross, and remember, this is just a random survey by an idiot, at the market's historical valuation average. That's actually really important because if you build an agent-based model, feed these responses in them, then randomly give them cash and take cash away, what you discover is a mean reverting valuation in markets. This is why things like the Shiller PE have historically worked. If you introduce passive investors into the mix, remember that they have 100% marginal propensity to buy and sell. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. That pushes the marginal propensity to both buy and sell off of that mean reversion towards what's called mean expansion. That takes the form of rising valuations over time, which unfortunately perfectly matches the underlying data that we see. This is the valuations rising. This is the median stock. This is the market cap weighted stock, which again plays into theoretical frameworks of why the largest stocks are more impacted on this. So we see rising valuations over time. If we then think about that in the context of how we measure manager performance, historically, we're used to thinking about a mean reverting market. The reality is now we have a mean expansionary market that causes those valuations to rise. If I take that same linear equation and I run it at various points in time against different passive share, my alphas are pushed negative, and that is unfortunately exactly what we're seeing. So contra to the argument that most people focus on, which is this idea under a Grossman-Stiglitz type framework that the opportunity set for active managers is growing, the path to that is actually very destructive to the process of price discovery and market functioning and ends up killing the active managers along the way. That creates a feature that's been very well documented, what's called effectively defection. Active managers increasingly become closet indexers, basically trying to preserve their career by minimizing their tracking error against that benchmark.
So two things on that. I wasn't going to ask this question, but you just brought it up. So um, when I talk to active managers, in many cases, it's like risk departments that don't allow you to deviate too far from an underlying benchmark. This has been a thing in fixed income for forever. Like you can't deviate too far from duration. You can't deviate too far from credit risk metrics. And the same thing in large cap, active management picking and things along those lines. So how much of it is I guess my question is, how different is this from a couple of decades ago where the active managers, yes, they were trying to outperform here and there, but for the most part, they were still, hamstrung within a bandwidth of where and what they could invest in?
It's largely a byproduct of regulation and the repeated experience. So in 2006, we passed the Pension Protection Act, I'm sorry. That changed 401ks from an opt-in framework where you would get a job and then choose to participate in a 401k to an opt-out framework where you would get a job and you would automatically default it into a 401k. When you created that, you had to establish what you were going to automatically default them into. That established what's called the qualified default investment alternative. Initially, that was balanced funds. There was some competition from active managers, but very quickly over time, we established legal precedent that said if you choose anything other than the lowest cost passive exposure as the sponsor of a 401k, you run an inordinate risk of being sued by your own employees. My favorite example is a class action lawsuit by Fidelity employees against Fidelity for offering them actively managed Fidelity products. So unfortunately, what you're describing, James, is exactly what you would expect because of two features. One, fewer and fewer active managers have access to that pool of capital because of the QDIA. About 85% of 401k participants never change their designation away from that qualified default investment alternative. And as a result, there's really no new entrant customers into the active manager space, or a very small fraction of it. The second feature is that then means because there are no new customers, the worst thing that can happen is losing an existing customer. And the easiest way to lose an existing customer is by underperforming versus your benchmark. Outperformance will retain it, but underperformance guarantees that you're going to get fired and your business moves rapidly into a terminal stage. This has driven a very clear defection that's actually well documented by the work of Valentin Haddad and Paul Hubner in the behavior of active managers themselves, they have shifted from being historically highly elastic and sensitive to valuation to today they're effectively very close to passive investors in many ways.
If you just take at face value everything you're saying, right? If you're viewing this as something that's distorting the markets and theoretically you should be propping up the largest names in the index, like if you're an adept active manager and you accept and see that this is happening, like why wouldn't active managers just lean into it and take advantage of this theoretical framework that you're laying out here? Like why wouldn't an active manager who sees this happening, understands it, just lean into it and take full advantage of it?
Well, first, we just described actually that they are, right? As they move to become more benchmark-like and less elastic, they are mimicking the behaviors of passive investors. Secondly, the largest and most successful active managers have done exactly that. By far, the largest business in the hedge fund space as a single distinct strategy is index arbitrage, effectively trying to front run the passive investors on events like index inclusion. Going beyond that, if you look at the production of research and where value is created in research today, the single most valuable piece of research is not 10Ks or analyst reports. It's what's called payment for order flow, which effectively gives details of what the noise traders, the remaining retail traders who now outnumber active managers roughly 2 to 1, what they are doing. Citadel pays on the order of $4.5 billion a year for access to transparency in the order books of Robinhood and other participants, precisely so they can position and trade ahead of that and maximize the value that they're creating in their option models and option market making. So, James, the quick answer is they are doing it, right? There's also a lot of people out there that are still unaware of this phenomenon and really don't understand how to exploit it. And then finally, there's a lot of people, myself somewhat included, who are basically saying, look, this is a systemic risk that we are creating. Your question to me, James, is some variant of, well, if everybody's getting high, why don't I get high with them? Right? Somebody has to keep an eye out for the cops.
So you kind of just answered my next question, which was, the active strategies that actually do benefit. But, you mentioned a hedge fund with index arbitrage. But if we think of just retail and, when I say traditional active, I'm talking about actual stock pickers, not the leverage or the defined outcome, but actual stock pickers. Is there anything that they can do to change their process to kind of benefit from this, aside from being benchmark huggers?
Yeah, I mean, effectively, you can isolate, and this is a lot of my more recent work, and it highlights, just how dumb I actually am, right? It took me almost a decade to get to the point that I fully understood some of the mechanics at the single stock level, and I'm still learning. I want to be very, very clear on that. But, the simple reality is that the only thing you can do is basically build predictive models to understand the impact and how that is changing. And again, that leans right into the index arbitrage, which I would highlight is happening not only in equity markets, but is also actually the story behind the emergence of the basis trade, which is simply index arbitrage happening in fixed income markets, where in many ways I would argue the current impact is equally, if not more, distorted.
Okay, so this brings me to my next question, which is a lot of these, and we'll put quotes around passive products. More and more, at least in the ETF world in our research, they are definitely being used actively. So you want to lean into something because you're betting on it going up, or most recently software stocks, software as a service, people worry it's going to get killed. So IGV, for example, is getting crushed, which is the iShares software ETF. So what ends up happening is I know you specifically said the S&P 500, but what we find is happening in the market is these things are being used actively. They're being used as pseudo futures. So they're betting on shorter term bets on these things. So theoretically, if you're betting on these baskets of stocks, there should be idiosyncrasies where something is getting bid up that shouldn't in that basket, or in the theory of the software stocks, there's probably some babies getting thrown out with the bathwater, right? So theoretically, with things like this and markets like this, wouldn't you think, in my mind, I'm as an active manager, I'd be looking into those, trying to figure out what's getting sold that shouldn't or bought that shouldn't, and trying to bet on those and reversions to the mean. Shouldn't this create some opportunities for active managers that are outside of just being benchmark huggers like we just spoke about?
I mean, the quick answer is at scale, it's incredibly hard. And you're asking people to develop a skill set with a lack of understanding of the mechanisms, right? And so, we're ostensibly having a debate about whether this is actually happening. If your assertion is it is definitely happening and you're willing to go out and make that claim and identify that Vanguard and BlackRock and the growth of passive investing is having a clearly caustic effect on the historical functioning of markets, and Bloomberg would stand behind that, I would bet that many more people would actually do it. But that's not where we are today. And so I think it's unsurprising that most managers try to continue doing what they were doing before.
So the next thing I had to ask, like if you look over the last, I don't know, we can call it a year, a few months, like we talked about the largest names outperforming, but like if you just use the eye test on some of this stuff, where are constantly names being removed from the index, getting sold off, constantly names being added. If you look at just the Mag 7 right now, there's a massive dispersion in their performance. I mean, if you just look at NVIDIA over the last couple of years. So there is still some sort of price discovery where NVIDIAs of the world are getting to be the largest names. Things are being sold off. Microsoft is underperforming the S&P 500 over the last few years. Like there is dispersion. So like from my point of view, I think what you're saying makes sense. Like it's the whole flows over pros argument where things are distorting over shorter time periods. But when I look at it, for the most part, things are selling off or being affected by what's going on with the underlying stocks and the earnings. And some of these valuations in these, these big name tech stocks probably deserve premium valuations over, any company in history, considering the margin expansion, the size and growth at which they're achieving despite being multi-trillion-dollar companies. So I guess my question would be like, what is your pushback on the, eye test argument? I mean, even if we go to like all the money still coming as far as US ETFs go into US domestic equity ETFs. I mean, we're seeing record inflows and still smaller caps are doing more better. Equal weighting is doing well over the last few months. International is outperforming over the last year or so. So like these eye test arguments, like what is the main pushback, I guess, from your research?
Well, first of all, when you think about the eye test component, recognize that you're actually trying to look at it and disprove the theory. So you're looking for confirmatory evidence as compared to actual evidence that is, confirming your point of view as compared to mine. Secondly, an eye test chart is absolutely not appropriate when we start thinking about these components for the very simple reason we're talking thousands and thousands of securities. Finally, when you talk about the largest stocks outperforming, that is largely a function of a misunderstanding of how passive impacts markets. We have formulas for market impact. Yes, size is a factor in that. But more importantly is actually the scaling of size relative to liquidity and the idiosyncratic volatility of the individual security. And once we start adjusting for that, James, like the quick answer is there's nothing else that really matters, right? Yes, an individual security can have a holder decide that they no longer want to own it and sell it. And in that time period, particularly if it occurs during something like an earnings report in which there is an absence of trading by the passive indices, they don't change their trading pattern on the basis of that change in earnings report, that information that flows through. That means that the market is going to be more volatile, or the stock is going to be more volatile in response to that earnings report, as the remaining active managers effectively are forced to trade amongst themselves with wildly divergent opinions. I can only buy from somebody who is short. I can only sell to somebody who is long or who is short, right? And so that process of idiosyncratic volatility has a meaningful impact on it that then is immediately ignored as that memory machine shuts off. And the next day you walk in and Vanguard or BlackRock says, this is the right price for that next incremental dollar. I want to be very, very clear. We would experience idiosyncratic volatility even in a market that was 100% passive for the very simple reason that there would be order books that would be of different depths across different securities. So it's, the answer to it is that it's not actually the smoking gun that you think.
And then my last thing before I pass it back to David, which is something I think completely agree on. I think a lot of this and some of the issues you highlight in this, demanding of solely investing in the cheapest index from ERISA plans and you name it, even investment advisors. Part of it has to do with the fact that like active managers were doing so well in the 80s and 90s, and there was no passing on the economies of scale. Like I don't think Vanguard would have grown to be as big as it was if active managers actually adjusted their fees, did things where they got rid of 12B1 fees. I think a lot of this has to do with the greed of the asset management industry and active managers overall over the preceding decades, where they just it was easy for a passive fund to outperform by simply, cutting the fees down to cost plus type of basis. Do you agree with that? Like, do you think that was made worse? Do you think it matters? What are your thoughts there?
Well, I think unfortunately that there are two separate phenomena that you highlight there, right? One is this question of, is it greed to not pass on the economies of scale? I think one that misunderstands the cost of launching investment strategies. An actively managed investment strategy has a fixed cost. Don't smirk.
I'm
An
so,
active investment.
I'm only smirking because Bill Gross was getting paid hundreds of
I,
not billions of
I'm
dollars
I'm
to
not
manage funds.
again. Let
Yeah.
me
Yeah.
let me actually finish the point before you
Okay.
start
Okay.
smirking.
Yeah. Yeah.
The simple reality is that to launch an actively managed product requires you to put an initial expense forward, at minimum hiring a portfolio manager, filing all the fees associated with listing the security, going through the process of obtaining distribution, and then you roughly have a 3-year penalty window in which you operate, in which nobody's going to invest with you until you've proven the results. If your results don't work, that's a sunk cost that you've lost, right? Is somebody returning that capital to you? No, you've lost it. All right. So you need to regain that through the economies of scale should you prove to be successful. Now, should they have been more aggressive in terms of offering those returns of scale? And you highlight things like 12B1 fees, which are largely actually distribution platform fees. Those are not the greed of the portfolio manager. That is the greed of the broker who is distributing the product. It has nothing to do with the portfolio manager. That greed has completely retained itself. We now see platforms on a regular basis charging active managers in particular access fees to the platforms that require us to effectively share a diminished revenue source with them. Larger firms like Vanguard or BlackRock are of size and scale that they can actually tell those guys to go take a hike. So the simple reality is that the system is actually biased against new entrants into the space. And were people overly greedy? Did too many people make too much money? Honestly, that sounds like the sort of lament that only a socialist would make, James. We can't possibly know.
Wow. I don't know. You have any comment, James, or should I jump in the next question?
No, not on that. I don't.
Okay.
I'm definitely not on the socialist bandwagon here.
Okay.
I have one comment after your next question, but that's it.
Oh, sure. All right. So if we look ahead 5-10 years, do you see a natural limit to the growth of these index tracking products, or does something have to break first?
The quick answer is we already have more than 100% of the flows coming through these vehicles, right? So to continue to gain scale simply means the status quo is in place. James and others have highlighted the growth of active ETFs. Again, I think the vast majority of those are mislabeled. They aren't actually active. There are very few actively managed ETFs in the traditional mutual fund sense. And so we actually are seeing accelerating share gain from passive strategies, as I described them, the market cap weighted strategies. We've accelerated to picking up roughly 4 percentage points last year in terms of market share. We're now well past 50% market share. This is actually setting up conditions for a purging not of the passive space, but of the active space, as the economies of scale are rapidly running in reverse for active managers. So if anything, I actually think that we will see a purge of active managers prior to the event. We'll see an acceleration in many of these symptoms. In terms of, is there a limit? Yes. Right. So that was actually the intent and observation behind the XIV trade, what became the Volmageddon trade. I recognize that there was a point at which the size and scale of these strategies would exceed the available liquidity in the markets, and that became an instantaneous go to zero event for that product. Unfortunately, it's the exact same math for the S&P 500. The difference is, instead of a $2.5 billion ETF, we're talking a $72 trillion market. That has far more important societal implications, and I'm far more loath to actually put myself in a position where I'm encouraging that to happen. But candidly, I'm a little annoyed that nobody actually wants to pay any attention to this, and so maybe I'll have to.
The last thing I would say, I agree. A lot of the active products coming to market right now are like we call them active in name only. You got like covered call products on S&P 500 and NASDAQ that are technically active. You have buffer products that are based on same indices or some other indices and technically active. You have single stock levered ETFs that are technically active, but that isn't to to put down what's actually happening, there is a lot of growth happening on the active ETF side. There is the likes of Capital Group, DFA, and others. But it is not as big as like the headlines would make it seem. And from my point of view, what I'm seeing more happen in the ETF space, you can see this when you look at the average fees being charged. For the most part, like you said, beta has become to S&P 500 has like basically become commoditized, but people are willing to pay up for those premium fees for people who aren't hugging the benchmark, right? There. So I think ultimately, I think the market at some point will sort this itself out if it's not sorted out in a regulatory way, the way that you're kind of hinting at might be needed. Just because I think people are like, I don't want to pay, 100 basis points for exposure to the S&P 500 plus or minus a little bit, but I will pay 100 basis points or 90 basis points for somebody that's truly active and going out there on the risk spectrum. And we're seeing that in the flows and like this core satellite type approach. But as you said, passive is gaining share. Though I do see somewhat of a slowing stance from the acceleration that we had recently seen, but passive is going to be 60% of the market before the end of the decade, as far as you look at mutual funds and ETFs on an AUM basis.
Yeah, so unsurprisingly, I push back against a few of those observations. One, the highest fees that are actually being extracted in the active manager space are for exactly those types of levered exposures. That's largely because you're taking advantage of the ability to access leverage within the institutional space that is unavailable to the retail trader. So if you wanted to have 2x levered NVIDIA as a retail trader, it would be impossible. You'd have to use your margin account. Your margin account would charge you somewhere in the neighborhood of 10 to 11%. Against a 50% increase potentially in your portfolio. You would be subject to individual margin calls, et cetera. It's far cheaper for them to access it. It's effectively an arbitrage phenomenon in which they access that same leverage through an ETF that charges them 1.25% to buy a single stock 2 times levered, right? So, one, I think it's a little disingenuous. 2, I think it's actually really important to highlight that if you go on many platforms and you try to buy an actively managed product, my high yield fund CDX, for example, on some of these platforms, you will actually be asked to sign a waiver of liability before they will allow you to buy them. Because despite the fact that my high yield fund, which has done extraordinarily well and is designed to actually limit exposure to widening credit spreads, runs at significantly lower volatility than the index while matching or exceeding the returns to the index, that product is perceived as risky under the regulatory framework, and they don't want to get sued. Now, imagine your customer comes to you and says, hey, I was just asked to sign a waiver of liability in order to buy your product when I can go buy the underlying product without that waiver of liability. What's the deal here, right? You're creating a friction into the process that is absolutely retarding the growth of those actual active managers that you highlight, James. I actually really strongly disagree with your observation.
Wait, so I was talking absent those single stock leverage ones. I was talking more along the JP Morgans of the world, Capital Group, DFA, American Century,
Yeah, I mean,
PIMCO, Janus.
Let's be really simple, right? So DFA is not active. DFA
Correct.
is a systematic strategy in which they overweight a particular factor, right? Has it worked very well? No. Is it largely based on a misunderstanding of what drives that factor? Yes. Do they have a cult that they've built up over the course of the past 30 years that allows them to transfer their mutual fund business into their ETF business, resulting in no net and actually negative aggregate growth to the active manager community? Yes. Is it showing up as growth in active ETFs? Yes. That's not the same thing.
I mean, my pushback would be a lot of the active mutual funds from the 90s were doing largely the same. They weren't really that different from the benchmark. And the final,
Actually, James, that's just factually incorrect. I can actually show you the data on that.
like, so is it your view that the detriments of the things that you talked about with like putting things into balance funds and passive cheap products, is your view that the detriments outweigh the benefits of people that were forced to put money to work in the market versus people just sitting in cash at the time? Because there are definitive costs and downsides that you've highlighted here, but there are also definitive benefits to end investors who are getting exposure to the markets at much cheaper prices and actually being invested.
Much cheaper prices for what? Much cheaper prices for management services, or much cheaper prices for the securities that they're buying?
Management services.
Right. So they are radically overpaying for the securities, but receiving subsidized access through management services.
Got it.
So asking the question, which is worse, I would much rather pay 1% and actually buy securities that are fairly valued so that I capture the expected forward return that's historically been embedded in markets as compared to participate in a rapidly inflating Ponzi scheme at very low cost.
Okay.
Great.
On that note, I think we need to end here, unfortunately, but this was a lot of fun, Michael. Thank you for joining us.
It was a pleasure. Thank you for having me, David and James.
Thanks, Michael.
James, thank you for being my co-host.
Yeah, thanks for having me, David.
I also want to thank our listeners. If you liked the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research and BI ETF Go for ETF research. Until our next episode, this is David Cohne with Inside Active.
Wasabi is purpose-built to free your business from skyrocketing storage costs and fees from the big guys. Wasabi is the go-to provider for professional and collegiate sports teams around the world. Check out Wasabi's AI-enabled intelligent media storage, Wasabi Air, and the industry's only cloud storage service with triple protection against cyber criminals. Wasabi, driving innovation in data storage for up to 80% less than market competition. Try for free at wasabi.com. Wasabi Hot Cloud Storage, proud partner of iHeart Podcast Network.
Well, the holidays have come and gone once again, but if you've forgotten to get that special someone in your life a gift, well, Mint Mobile is extending their holiday offer of half off unlimited wireless. So here's the idea. You get it now, you call it an early present for next year. What do you have to lose? Give it a try at mintmobile.com/switch.
Limited time 50% off regular price for new customers. Upfront payment required. $45 for 3 months, $90 for 6 months, or $180 for 12-month plan. Taxes and fees extra. Speeds may slow after 50 gigabytes per month when network is busy. See terms.
This podcast is supported by FX's Love Story, John F. Kennedy Jr. and Carolyn Bessette. The new limited series from executive producer Ryan Murphy. It explores the complex courtship of the iconic couple considered to be American royalty, whose love story captured the attention of the nation. Their fairy tale romance would unfold in front of the public eye, where their private love would also become a national obsession. FX's Love Story, John F. Kennedy Jr. and Carolyn Bessette. Watch now on FX, Hulu, and Hulu on Disney Plus for bundle subscribers.